Hello, everyone, and welcome to this joint webinar from MobiFin and Juniper Research. Today, we are here to talk about AI-powered composable FinTech and how this is really going to have a major impact in terms of how financial products are built, developed, used over time. It's a great topic. I'm really pleased to be here speaking to you about this, and thank you everyone for joining us today. Just a couple of things at the outset. There will be a few interactive elements today to this webinar. So there will be a few polls, so we will let you know when those are popping up on screen, so you'll be able to get your voice heard in our webinar. As well, there is the opportunity to ask questions of myself and Arun. Yes, if you can pop those questions in the Q&A tab, you should see on the top right of your screen. Also, finally, there will be a few materials that you can download about the topics we're discussing today. Those will pop up on screen as we go through the presentation, so feel free to check those out. Great. Well, with all that out of the way, let's get into the topic. So, firstly, who are we? So, I'm Nick Maynard. I am VP of FinTech Market Research here at Juniper Research. I cover FinTech and payments exclusively. I have been doing this for about 9 years now. Speak to a lot of the vendors in this market, and so yeah, feel really well placed to have a really interesting conversation about these topics with you guys today. I've got the pleasure of being joined by Arun. So tell us all about yourself.
Yeah, thanks, Nick. Hello, everyone. Great to be here and glad to be talking to you. I am Arun Tangsali, and I am the CTO at MobiFin. I have been building banking software one way or the other since the early 90s, and that makes me as old as I look. So here I've been leading MobiFin for the last 4 years or so. And today, it's a great topic, AI and composability in FinTech. I'm looking forward to this conversation, and so thank you very much for being here.
Perfect. Well, let's start off with what we're going to achieve today. What are our objectives? So firstly, we're going to show, and really this is a trend that I see happening day to day, is that there's a structural shift in how financial product creation works across segments. And that's from having one-off, very complex builds to a more systematic approach to this. So we're going to see how that's looking on the ground. We're going to be defining the composability framework and actually what's powering this shift. What are some of the technologies we're seeing introduced? Now, we're going to take that from the abstract and put that into the practical and see what that means in specific segments, what impact that's going to have on the day-to-day, and what key use cases we're going to see. And it's important to say it's not going to be a discussion on broad AI trends. There's lots of webinars that will do that. We're going to go into the specifics in what it means for banks, credit unions, neobanks and fintechs and digitechs and platforms. So hopefully that will be really interesting to you guys out there in the audience. So let's set the context for this one. And it's really important to do this because we're seeing a big shift in the market. But before we get into all the details here, let's start off with a poll to you guys, the audience, on what you're seeing at the moment. So that should now be live on your screen. So the poll question is, when launching a new product, where does most of your team's time get spent? So we've got a few different answers there. So if people can put their thoughts into that question. We've got an early answer for testing and regression checks, and now I can see your answers are starting to come in. So it's always interesting to get people's perspective on the sort of challenges they're actually seeing in the market. And it's looking pretty even, which I think is probably what we'd expect. I'll give people just a few more seconds just to get those responses in. Okay, so if we stop there, so what we can see is actually coordinating across systems was the leading place where teams are spending most of their time, followed by testing and regression checks, and risk and compliance sign-offs. But actually, all of these were seen as key issues. And I think that reflects where we are as a market. We're in the midst of an impending shift in the way financial products are delivered. And that's not because we're all looking for things to change. It's because the market reality is driving this shift. And if you're a financial institution, you are launching more products across more channels. It's no longer enough to stay where you've always been as a fintech, as a bank. You have to explore new products, and that's increasingly important to surviving in such a competitive market. We're seeing a greater shift towards embedded finance. That's something we're seeing happening on the ground. Embedded finance, that business model is really taking off. Along with that, we've had, obviously, in APIs, application programming interfaces have been hugely impactful, but they've improved connectivity. They haven't improved the agility around products, and there's still an integration challenge around this. So it's important to note that. And what we are seeing with our customers in these markets is actually, although they can reuse things like APIs, the product logic, the workflows, and all the controls they have to have around their products, they're rebuilding that constantly. It's 75% of the task between building products can be exactly the same. And it's being redone and redone constantly. And that rebuild cost is a really significant consideration, and actually a real handbrake on innovation in these markets in terms of product. So that's why we see that composability and reusability are incredibly important. And actually increasing this speed of product creation is super, super important. And that's what we're seeing in the market right now. So with that, on to the next one, and over to you, Aaron.
Yeah, thanks, Nick. Yeah, I think that sets a great context to how financial products are being built so far and where we see that heading. If you look at financial products, and I'm probably preaching to the choir here, they're all experts in the audience, sure. And going by the responses to the last poll, I think they know exactly what makes financial products complex to build and run. Right? But if you look at the products today, they are accessible across a very wide variety of channels, apps and web pages and chatbots and things like WhatsApp or voice calls or ATMs or in-person tellers, even that's still relevant. And yet all of these themselves don't really define the product. It's the heart of these products, to make them consistent, to make them deliver the same kind of behavior or experience across all of these multitude of channels, means that the real heavy lifting happens behind the scenes. And that's the back-end logic, and that's where the product and its behavior lie. Take a typical product, and there are multiple requests or multiple inputs that are part of a request that a user would make. You would bring in, let's say, KYC data or something like that. Then you would talk to a bunch of different systems, bring in a lot of data. Then you would add some validation mechanisms to make sure the data is sane before you take any steps on that. Then you'd bring in a whole bunch of rules to act on that data. The rules could themselves be part of the product. It could be a lending product where you say that you want certain access to a product already available with the customer before you proceed further. It could be product level rules, or it could be organization level rules, which says that you have a certain risk profile that you want to maintain, and hence you would want to not allow certain kind of customers to access certain kind of products. That's more organizational kind of a limit. And then you could potentially have regulatory rules which say that you need to do things in a certain way, and they could be laws of the land which require maybe another specific set of rules to come in. So all of these different rules, they could be different for different products, but quite often many of them tend to have very similar applicability across multiple products. All of these rules, and then you would apply those rules, and what you end up is a bunch of decisions. These decisions would be whether your product is approved, whether a person has moved from a silver to a gold category, or an account has been marked delinquent, whichever it is, but there is a state that gets generated because of that decision. And all of this really represents the product that we are talking about, right? It's not the screens, it's not the user interface necessarily that happens. Those are all part of the product, but the real heavy lifting is really what happens behind the scenes, the behavior that's embedded in the product logic. And all of these multiple steps that we talked about, they all need to be done in a way where you can have full traceability. If there is someone who comes for an audit, you should be able to say this particular request was approved, denied, or whatever is the appropriate decision taken because of these specific steps and rules, and you should be able to demonstrate that. So I think those are essential parts of a financial product, and these are complex, right? There's a lot of complexity that happens behind the scenes, and that's really where I think there's a lot of work to be done. And looking at some of the responses earlier, I think our audience really understands what those challenges are, and I'm sure it would be easier to talk about what potential shift we need to bring in to make this go away. So, so if we take a quick look at what how products are being built today, right? So it's products are being built in by bringing in new elements, right? There are custom APIs, middleware, API gateways, what have you, microservices, all kinds of things that are being brought in to help build products. But quite often what you end up doing is each product becomes a custom project from an IT or services point of view, which means that you end up having to explain all of this behavior to someone who's actually implementing them. You then take pretty much the same thing that was done previously in another product and replicate that here. Becomes another new siloed in a tool or platform that you're deploying to make that product happen. And this is often the case that you would start to deploy it, and you will get questions like, we've implemented this particular behavior or this compliance in product A just 6 months ago, and how come it's missing in this product? We already went through this, and yet we are, and we are redoing all that. We are still figuring out that we need to do it all over again for this. And I think that becomes an essential part of how products are being built today. And so what we think can change significantly is where we treat all of these different the data sources that are part of any workflow, the rules that need to be applied, the decisions which need to be taken, the states which need to be managed, all the traceability and the audit logs which need to be generated at different stages. If all of these are different blocks that are available on the platform, and instead of requiring you to write custom code or hire a software services team to build all of those things, you could take all of these different blocks of data, rules, decisions, state, logs, and all of these and assemble custom workflows on your own. I think that can be a real big game changer. It can help you reuse components that you have built for some of the product and create new products much, much more quickly. So this whole model of composability revolves around using blocks which do small discrete atomic activities and assemble them to a larger workflows, and a bunch of these workflows could then become a product. And all of this could be done in significantly faster time, days instead of weeks or quarters even, for getting a product in place. So that's sort of how we see this shift happening, where all data, rules, decisions, states, they're really blocks which you can play around with, hook them up in different ways and create your own custom logic for whatever product that you want to build. I think that's sort of the direction we see all of this heading. Nick, you want to talk about composability?
Yeah, absolutely. And I think there's some really interesting points there around how the model's changing, and fundamentally composability is becoming an important consideration. And actually, rather than doing product builds as discrete activities that are not reused and repurposed across different product types, what we're seeing is that composability is enabling this to be more smartly reused and actually enables the speed of financial product creation to accelerate. So it's about assembling reusable governed behavior blocks. And that's so new products are composed, not rebuilt from scratch every time. And let's firstly define this by what it isn't. It's not just stitching different APIs together. It's not creating plugin marketplaces. It's more composable than that. It's having the ability to connect services in a more intelligent way that can be done in a more sort of creative and seamless way, rather than just offering the API connectivity. And what it is fundamentally is a product assembly model. There's 5 pillars here. Composability, so being able to put it together. Atomicity, so being able to separate it into separate parts that can be reused. Interoperability, so having the ability for all of these product components to work with each other in a really seamless way. Reusability, that's so important in terms of being able to reuse effort you've put into this when you're creating new products. And testability is, of course, important as well. You need to be able to see this works in practice. And finally, orchestration, being able to offer all these products together, have it all make sense together. This is vitally important. And it enables, I think, what we've talked about is scale and speed. You can move much faster. And this is really important in a financial services market, which is only getting more competitive over time. User demands are increasing. People expect things to be seamless. They expect them to be hugely effective. So it just puts extra pressure on the financial institutions and other sort of stakeholders to make sure that their services work perfectly. And it matters because the complexity of products is outpacing the rate of delivery of products. We've got embedded finance is growing massively, more product variants, more partners. So many financial institutions are trying to expand into new markets where they don't have the experience. So all of these factors mean that the pressure on the institutions and the companies building these solutions is so high. So by taking a composable approach, this can really help lift that burden a bit. And if we think about what that means in terms of the 4-layered composability stack, so this is sort of the stack that makes this all work. So we have digital primitives at the bottom. These are the atomic financial capabilities. So this is things like verifying identity, running an AML check, creating an account. These are all things you need to be able to do irrespective of what the product is. So having those available across products is hugely important. There's the orchestration layer where these atomic elements can be combined. They can be used together in a journey. That's hugely important. So combining a KYC and a sanctions check, doing a risk classification, this combines multiple functions. Then we have the access and API layer. So ensuring that different ends of the product journey will connect, ensuring that a partner portal can be connected to, an agent channel works, a mobile app can sync with the product. And also there's always going to be governance and observability, and this is critical. Having policies and limits enforced across different products, ensuring that there's that traceability and auditability is hugely important. And having that portfolio level visibility into risk and change impact. And that one is so vital. Governance is a topic that keeps coming up and up again and again with financial institutions in terms of how they can keep visibility of this and how they can make sure that actually small changes to their products don't translate into big swings in the risks they are exposed to. And keeping a control on that with a solution like this is hugely important. This taking this approach enables reuse and governance at scale, which is hugely important as we move into this highly competitive market. So back to you, Aaron, to talk about the product assembly layer.
Sure. Yeah. Thanks. Thanks, Nick. I think that gives a very good definition of what composability really is. But if you take a look at from a slightly different perspective, what do most financial institutions have today? If you look at the bottommost layer, there are plenty of APIs, there are middleware, there are API gateways, which are available in most institutions, and you could potentially stitch them together to do what you want to do. But all of them doing all of this, creating the required connectivity between all the different disparate systems that together run an organization today is a project. So pretty much every product is more than one project often to get things running, and all the challenges we noticed earlier, coordinating across systems, testing and regressions tests, checks and risk and compliance sign-offs that we saw coming up in the top in the poll. All of those are things which you really need to do as custom work. Per product, you want to do all of those things, and which is a long haul and a lot of effort that goes into that. What most organizations want to do is not really worry about these bits and pieces, but focus on the top layer. What financial product should we build? What features should we offer our customers? What is the right way for us to evolve the products that we already built to make them better suited to our customers' needs? I think that's the strategy that most organizations would really want to be following, and that's where they want to think. However, a lot of their time and effort goes in taking care of the minutiae of actually managing these different components and finding out how to stitch them together to do something useful. I think that's where we see this missing layer, something which can take all these bits and pieces that exist within an organization. And you really can't do away with those things. You have all the systems, the recent ones, the legacy systems, the different data sources, the different access channels. You've got all of those things. How do you take all of those things and still stitch together to create the right product that you really want to build? You evolve those into having the right kind of features that your product team wants to do. That's where we see this missing layer. I think that's where we see that becoming a gap that we think we can fill. Right? So MobiFin Tapestry, and I'll talk about it a little bit more towards the end, that was built to address this specific kind of gap. Right. So, without going too far into what Tapestry is, right, the kind of problems that we talked about, coordinating across systems or testing and regression checks and risk and compliance sign-offs, these come kind of baked into what Tapestry can do. And it can solve problems in much faster way than what you would do with any other mode of building products. And we will talk a little bit more as we go along. But it can take all these different components that exist, package them into blocks, and make it available as components, which you can then literally compose and assemble together the product that you really are wanting to launch, and do it in a very quick and compliant way. I think that's really what Tapestry is about, and we'll talk more about it as we go along. So, Nick, you want to talk about this?
Yeah, I think probably at the outset, as an analyst, obviously we are of course aware that when we use the term AI powered, then people will have thoughts about that. I think it's important to talk here about what AI is doing in this product model and what AI isn't there to do. And I think we're not talking about AI as a general solution in terms of, it's a chatbot or it's used for surface level automation. That it's not there to do that. It's not there to run risk policy or compliance logic. That's not what it's built into. And that's not what it should be used for in composable product assembly. What it should do, and I think the sweet spot we're seeing emerge with AI use, is allowing it to accelerate human intention and human behavior. And here what it's done, what it's here to do is it's here to automate and make it easier to translate that product vision into a product reality, creating that workflow, moving together those blocks, introducing the right connectors, and making sure that those workflows come together in a sensible way, and just speeding up the speed, that rate of iteration that you get when you're building products. That's what it's here for, not for it's AI powered as a description. So I think it's important when we say AI powered to make that super clear. Any thoughts there, Aaron?
Sure. No, I think you hit the nail on the head there. If I want to, if I take a moment to elaborate a bit on that, right? So, if potentially a social media organization could say, we are going to block a user because our AI said so, and they could potentially get away with it, right? But a financial organization can't really do that. You need decisions which are explainable. That's the heart of how the challenge which AI is posing many organizations today, not just finance. When AI responds back with something, it's always, it's not always something which you can understand the rationale that it applied. You don't know what logic it took to reach a particular conclusion. And you can't really go back and tell a regulator that, I did this because AI said so, right? So obviously that's not a viable option. So essentially what we think is that the products that you create, of course it can use AI for many things, but it needs to behave deterministically. One of the challenges, which I'm sure as users you'd have seen, is that you go to ChatGPT and start, giving a prompt. It doesn't necessarily give the same response back the next time, and I think that's a fundamental problem with AI, particularly in the context in which we are talking about highly regulated businesses, which need to behave in very predictable, very deterministic kind of ways. So we see AI as working at a couple of different layers here. First, we think workflows, products have to behave very deterministically in a way that you can explain every single step, every single activity that happened within that. And if a regulator ever asks you, why did certain thing happen in a certain way, you should be able to show all the trace of steps required to go all the way to that point, and be fully compliant on that side. But what I think it can really do is help translate your business intent, your what processes you're trying to build, into a language which is appropriate for the tool. You don't need to spend as much time learning these tools, because you can then converse with it in a more natural language and help it understand what your intent is. Help the tool take your intent and convert them into the right specification, the right language, to make it create the right workflows. I think that's using AI to help assemble the product, while the product itself works in a more deterministic fashion. I think that sort of distinguishes between AI as a build time tool versus AI as a runtime tool. And I think there are ways we can make that work very well, where your team uses AI to create those products very quickly, but the product itself behaves in a very predictable and deterministic fashion, and which make sure it can comply with all regulations much, much better. I think that's sort of how we see that working. So I think that's our take on AI there.
Perfect. So with all that in mind, we've talked sort of in the abstract about the changes we're seeing in financial services. This new model is emerging, but how does it adapt to different segments? Obviously, financial services is highly diverse. There's lots of different product types. There's lots of different challenges that people are seeing across this industry. So how does it adapt to these different segments we're seeing? So there's a few segments we're going to cover here. As I mentioned at the top, we're going to look at banks and how it can turn fragmented system estates into orchestrated products. We're going to look at credit unions, which are sort of on their own journey in terms of trying to reach scale without necessarily having that giant sort of infrastructure that banks have had for so many years. It's about neobanks and fintechs and how they are scaling so rapidly, but whilst keeping risk under control. And it's about digitechs and platforms and how they can embrace the potential of embedded finance without hitting the challenges that go with that, and how tools can really help them better navigate that. So let's start with banks. And banks are obviously a huge presence in the financial services ecosystem. They typically have huge product ranges. They have lots and lots of products across different parts of the fintech and sort of banking space. That being said, they want to ensure that they are in a really good position to launch new products, whether that's across lending, payments, savings, embedded finance. The rate of change within the fintech, banking, payments ecosystem is so rapid that banks need to keep up with this rate of change. And that means launching products, it means testing products, it means iterating on existing products. So there's a huge pressure to drive change faster whilst preserving that ability to withstand what the regulators might have in store for them at any given point. So this is a bit of a tightrope they need to walk in terms of updating their products. And the current situation with how product innovation happens doesn't really help that. There are huge amounts of existing legacy and modern systems, in some cases between 10 and 20 systems at each bank. And yet I speak to banks regularly where they have what can only be described as a bit of a mess in terms of a technical setup. They use certain products for they use certain capabilities for different products. They have some products that run on completely different systems. They meet in between with a KYC system. There is a huge level of technical complexity, and this makes it a challenge. It means that you have to synchronize teams, processes, and this can be a lot of the effort is on the technical side rather than the product side, which is a real limitation. This is because fundamentally, from a banking point of view, these systems were never designed to work together in the state they're in today. They were not designed to function in that way. So really ensuring that they can function together and that they work correctly is a really important challenge. Ensuring also that small changes don't derail the whole system. If you've got 10 systems you need to update and you need to do a quality of life improvement, that should not cause problems across all of those systems. Now, really with composability, that can change because we have those reusable blocks. Those reusable blocks can be updated. The product behavior can be defined once, and then that filters into the individual systems. So this ability to orchestrate makes this whole problem easier to solve in terms of how this is approached and how making it much more seamless for new products to be assembled. So that is really that's a really important one. It creates faster product launches. It has reduced delivery and regression risk across portfolios. And it creates the ability to think about products without necessarily thinking about the systems that go under it. That freeing up from that sort of technical debt and that real challenge there is vitally important. And that's something we think will become increasingly important for banks. So, Arun, why don't you take us through some of the key use cases here for banks that we could see powered by this system?
Sure. Yeah, thanks, Nick. So, like Nick was explaining, banks have dozens of systems, and they're really not originally designed for it to integrate together or work together to create products, like we need to do today. In fact, if I take a little step back, even very recently, there could be multiple products, multiple systems that are accessible to someone operating in a branch like a teller or something. And a person could walk over to them and the teller would happily log into 2 or 3 more systems and do what is required to reconcile information and get whatever is required by the customer out. Now, with the huge increase in self-service requirements, people don't really want to go to the branch. And yet these different systems, which were integrated purely in the hands of the teller or the human there who was integrating all this information together, now needs to happen through systems and be made available to the end users to actually operate like it's an integrated system when they really are not integrated, which is where a lot of the complexity comes in. So if you take examples like a bank wants to extend a SME credit kind of a system for local businesses, or launching a merchant payment distribution system, a disaggregation system, where there are tons of marketplaces around, and almost all of them would need multiple ways to distribute accruals through the whole channel, bits and pieces across the whole pipeline there. And yet these are different. While these are different systems, they essentially have many common elements. And in a traditional bank, these would probably be in very different kinds of teams, and they would have their own approaches doing it. Probably end up doing them as independent products, create new middleware for each of them, and then launch. With each of them taking 6 months, a year, or whatever it takes to get those things done. But when you're talking about composability, many common elements like identifying a merchant, authorizing or authenticating the merchant and deciding what is available to that particular merchant as a service, having access to the ledgers of those particular merchants, connecting to KYB or AML kind of workflows. All of these can be reused as blocks because they would be very similar across both of these. You don't actually need to go and create from scratch both of these. You could very well reuse blocks and do the incremental additional logic you would need to make one from the other. If you have built, let's say, a SME credit for local businesses first, then with very incremental kind of effort, you could very well create a merchant payment disaggregation product without starting from scratch. I think that's the kind of power which a composability brings in, that you take existing products, pick elements of relevance to another product, and then piece them together into a whole new thing that you want to launch. I think that's really where composability shines. And while that's a small example for banks, there are plenty more we could do in banks, particularly when there's such a large variety of systems. Each of them could very well be repackaged back as a block. So if there are a dozen systems, and each of the capabilities that they expose could become individual blocks, which means that you could potentially have 100+ blocks within your organization, plus maybe the 70, 80, or 100 that Tapestry keeps adding more and more. You have a rich collection of blocks which could then mix and match to create the products that you really desire. And that's really where composability comes in.
Great. So let's move on to the topic of credit unions. And this is a really important one, particularly in the US, where the credit union market is huge. Let's start here before we get into the complexity with credit unions. We've got our second poll for you. So let's get that out to the audience. So this poll is, with what we've seen so far, which shift feels most relevant for how your organization builds products today? And there's a few different options here, from building products one by one to assembling them systematically, moving from hard-coded logic to orchestrated, from product-driven delivery to reusable product foundations, from speed to scale-safe product evolution. And the one we hope you don't pick, none of these resonate yet. We'll give the audience a few seconds just to drop their thoughts in there. Delighted to see that we've got some questions coming in already too. So everyone remember that, of course, you can ask questions at the end of the webinar. So keep those coming in. We'll get to those. I'll give just a few more seconds for some poll responses. And okay, so we have from speed first launches to scale safe product evolution, clearly resonating with the audience, which is interesting, and also from hard coded logic to orchestrated product flows. And I think that really matches what we've been talking about. That's a real clear key consideration in this space. But let's talk about credit unions. So obviously, like I say, hugely important in the US market. They don't have the technical complexity that banks typically do, but they also don't really have the product complexity that they need to compete effectively in a lot of cases. So a lot of the time they serve niche audiences, such as small and medium enterprises, or it could be veterans or military personnel or very specific niches. And really what they're looking at is how do they compete effectively with banks, with neobanks, with digital-only banks? How can they play in that market? And that's really about how can they launch new products? How can they get into the digital credit market? How can they compete on experience with a lot bigger brands without causing themselves any regulatory headaches? So that's really important. At the moment, they are very heavily reliant on vendors and on point solutions, and that means there's a huge risk in terms of buying into specific vendors to just launch a specific product. It's very roadmap driven, but there's a lot of integration required for that, and it's very difficult to manage that at a wide scale. Alongside that, a lot of this with this traditional model is an IT project. It's not seen. That is a huge barrier to sort of product innovation, and the risk feels difficult to manage. Small teams also struggle to sustain continuous rebuilds and regression testing with all of these products being innovated. Now, with composable product assembly, that becomes much easier. Reusable governed workflows reduce dependency on one-off vendor builds. So there's a lot that can be reused between different product types. Also, we have compliance is embedded. It's not retrofitted. So it's there by design, and that really helps in terms of when credit unions are stepping into new markets. That means that credit unions can focus on delivering value for their members, not just figuring out the infrastructure plumbing that goes with all these new products being created. So that is a really important accelerator to what credit unions need to do to stay competitive in an increasingly difficult market for lots and lots of reasons. And again, let's look at some practical use cases for credit unions and what they're facing.
Yeah. I think very similar to the larger banks, credit unions, may not have the same kind of legacy that the larger banks have, but their requirements are very different. They address a different segment, and I think even more importantly, they face their customers sort of lay out the same expectation that they would get from the bigger banks. So essentially, from a customer point of view, a lender or bank would have to have the same kind of capabilities that the larger ones are having, and that puts pressure because expectations are changing. And for something like that to happen, a platform which comes with not just the ability to stitch together what's present, but has significant capabilities built into the product would actually make things easy, because then you can leverage those capabilities and build new products, not just by using what you have, but what's coming along with the platform. So one of the things I want to point out here, maybe a little different than in the bank's case, is, for example, wallets. That's a common need, whether you want to use it as a way to handle small amounts of money, small payments to be done much more easily and much more and frictionlessly, then wallets are really great for that. And a platform like Tapestry comes with wallet capabilities built in, which means that you could take all the traditional banking kind of products and mix it with wallets, and you will get a whole new kind of capabilities. So coming to this model of reuse, having some built-in capabilities would mean that you can use them across multiple different products, and those default capabilities of the products become shared reusable building blocks for more than one product. And that's an easy way to launch new and innovative products beyond what even the banks are doing when credit unions use a platform like Tapestry. Thanks.
And I'm on mute. I can't believe I was the first person to do that during the webinar. In terms of then neobanks and fintechs, this is a really important one within the space, because neobanks are in a position where they're trying to scale up. They're competing with traditional banks in more areas. They need to move faster. They need to move rapidly in terms of what capabilities they're trying to achieve. and really turn customers who are using them for the odd account, for a specific reason, for specific benefits, into long-term, loyal, sticky user relationships. So there's lots of need to launch, iterate, and retire products continuously. They are much keener on embedded finance as an approach. So that's something that needs to happen. And it needs to, of course, include all of the regulatory and operational scope that needs to happen to support this process. At the moment, there are features are shipped directly into the application code, but this means reusability is a challenge. Financial behavior becomes too tightly coupled to product code, and rules and controls are duplicated across features. There's lots of risks here. There's increased regression risk with each new launch. And this means that eventually cost and fragility will rise sharply with these systems. So there's a real challenge here. With composable product assembly, this is financial behavior is externalized from application code. So really the risks here are minimized. Core workflows become reusable. So as they try and scale really rapidly, they have the ability to do that and reuse their efforts. It's products being assembled through configuration, not redevelopment. And that has massive impacts in terms of increased confidence in governance and controls, whether it's increased product velocity, lower operational drag. So there's a real set of benefits here in terms of how that's will have a major impact for neobanks. So again, let's look at some core use cases for neobanks. And actually, I think this is where we are doing our final poll of the webinar. So let's get this one to the audience. So we have poll number 3 live. As your product portfolio grows, where do you feel the biggest challenge today? So what are we finding challenging? There's obviously, we're all in different places in building products. We, for our part as an analyst house, we see our customers challenge with all of these elements. It's not any one thing. There's lots that's going on, and lots of challenges that are happening across our portfolios. So we'll just give it a few more seconds for the final answers to come in. I can see all of the above is resonating with most. Rolling back and changing features safely, clearly a key one, particularly with all those different systems needing to be integrated, particularly if you're a bank. Lots and lots of risks there. So if we close that poll now, and maintaining product velocity as well was a key one that came out there, and absolutely something that's important to consider.
Right, yeah. But all of the above seems to resonate quite a bit, actually, and I'm not surprised at that at all. Plenty of challenges. Well, so looking at neobanks and fintechs particularly, I think they are the ones where velocity is really going to be so much more important than any other bank. I mean, their whole claim to fame is the ability to move fast and hopefully not break things, but at least respond back very quickly to customer demands, and probably in a way much that really shows that they are listening to the customer. So I think velocity is really, really important, and maintaining product velocity, which someone has responded to here, is really critical. When products are being launched with that kind of a velocity, first, you need a few aspects which need to be considered. First, you need the ability to compose and build products and assemble together product without having to write a lot of code and then launch them quickly. I think that's kind of essential. Without that, you really don't get the speed that you want to. But coupled along with that, and we talked about that speed earlier as well, and while that's essential, what is equally important is the ability to iterate on those products. When you launch fast, you will get plenty of feedback. You want to evolve those products and keep your customers' feedback top of mind, which means that you'll probably have a version 2 or a version 3 or version 4 of that product go out in a matter of months. So in a typical conventional or traditional bank, where a product could take a lot of this, be a long gestation period to get the specifications right and launch it in one go. Banks and fintechs probably are going to do a very, very iterative kind of process. What it means is that the ability to version manage those products is going to be equally critical. Again, by using a platform which provides composability through blocks, you could very well have these workflows done, and that workflow definition itself could then be having a multiple versions and iterations, and we could deploy them. Again, I'm jumping ahead a little bit, but a platform like Tapestry would provide you mechanisms to have a version running on the production while you're testing a different version on the sandbox. That gives you the ability to try out new features without necessarily disturbing what's going on in the users. And then once you're happy with that, go and launch that. I think that makes it really, really effective for neobanks and fintechs to maintain the product velocity without really running the risk that they had to go back and do things very often, because you could very well have a sandbox where you could try and launch these things very, very quickly. Again, the same element of reusability. When you have a new version of the product, you don't really start from scratch. You take the previous version, tweak the elements that make it different, better, and the quality of life improvements that was alluding to earlier, and then launch it back very, very quickly. So I think that kind of capability is what composability brings to neobanks and fintechs.
And lastly, looking at digitechs and platforms, and I'm very conscious of time, so I won't labor the point too much here, but digitechs and platforms, they obviously are massively interested in getting the benefits of embedded finance, but they don't need the domain regulatory and operational complexity that comes with that. And there are a lot of challenges here. Embedded finance is usually delivered through a bespoke integration per partner or use case. That's a way to get a interesting product into field. But if you want to build multiple products, it's not particularly helpful. Each use case is like a one-off project. There's very little reusability. With composability, you can reuse parts of this. You can make sure that embedded finance journey continues, and that you can build product after product and really build that from into your sort of digitech or platform. So there's some key benefits there, and sort of some key considerations too, and some good use cases here as well, Aaron.
Right. I mean, in the interest of time, I'll keep it simple. So, digitechs really are see a financial products as the easy value add for their own platforms. It could be a food delivery app which also does something additional, a travel booking app which also offers insurance. It's very easy to kind of bundle in a financial product into a core non-financial kind of a platform. And when you do that, those digitechs really don't want to be worried about all the regulatory complexities that a normal banking or a financial organization would want to do. They want to hide that off to the organization which really understand and know how to manage that, while all they want to do is really use it in a simple enough fashion. So again, the same composability that we talked about earlier allows these products to be not just packaged for use by a front end like a web app or a mobile app or WhatsApp. You could also package exactly the same functionality and make it available to a digitech, which means that it could actually very well take something which is a consumer-facing product and it becomes a B2B offering from a platform point of view. And from a digitech point of view, it simplifies a lot of the heavy lifting, because they don't need to worry about compliance. That's already baked into the platform and someone else is kind of taking care of it. And all they are doing it is using the capabilities that are being offered to them. So win-win for both the banks as well as the digitechs there.
Great. So onto the important part, which is how Tapestry pulls this all together.
Yeah. So it's been a great conversation so far, and just a few minutes for me to sort of convey what Tapestry is really doing. So Tapestry is a build, test, and deploy platform for fintech, which takes care of all the essential elements of building through a composable mechanism. It has a great number of fintech primitives, creating accounts, authorizing users, authenticating pins or passwords, calculating fees, commissions, taxes. All of these are things which are built as primitives and made available for you to build. And then it has orchestration mechanism which allows you to connect to your existing systems, or third-party systems that you depend on, like a credit scoring agency or your internal AML. All of these things you could build together and make them available as blocks. So Tapestry has the means to connect to these external systems or your internal systems and repurpose them as blocks. And all of these blocks could then be pieced together into workflows that you would deploy, or you could actually compose them and test them right there in a system which is identical to where it's going to run. I think what makes, and I see a question from Chris, and while I'll answer that in more detail, it sort of is a good point to bring in here as well, that what Tapestry is really doing is not just building a platform to compose these things, but actually providing a platform for runtime execution of these workflows as well, which means that you can actually test it in a near identical environment to the one that's going to be on production. And with a single click, once you're happy with your testing, you could actually deploy it to production and get it live with really no additional effort to take the product to the customers. So that kind of is what Tapestry really does. To make things simpler, we talked about AI being used as a composing or a composition layer rather than as a runtime layer. And I think that's really baked in. So we have this element called the magic builder, which means that you need to understand all the dozens, actually close to I think 70, 80 primitives that Tapestry comes with. You don't need to understand every one of those things. That's understood by the AI engine. So what you describe is your business requirements and the intent that you want to achieve in more natural English, and it will pick the right components that are available on the platform, what components have been connected to through the connector layer, and piece together the right workflows, which you can actually test right there. So you get fully validated workflow initiated via AI, and which you can then deploy and run. So that makes it really, really powerful and capable. And all of this comes to you with the ability to launch new workflows in really days. We actually have a prospect who's been doing a POC with this, and I won't name the country right now, and they wanted to build an international remittance product, and they could actually build this whole product in about a week's time, and their initial assessment was close to 6 months to build that kind of a product. So the kind of speed that we see Tapestry can bring is just enormous, and it can really be a game changer for that. And all of this comes with full-blown governance framework in place. So every critical parameter is something which you would have an administration mechanism to manage those parameters. Every single step of the workflow can be traced. There's good observability across the whole platform, which means that every single decision or rule that get executed, 100% visibility across everything. So it's a very powerful platform for a finance system. And you can build lots of different products, which means reusability is even better, because you can take the same platform and build all of these and plus more on that. So I think that's sort of the very quick 2-minute spiel on Tapestry, and I'll be happy to answer more questions offline for anybody who wants to do that. We've got just a few minutes left.
Perfect. So yeah, and there's some links people can access here if they want to. Some details there. I think we've probably got time only for one question here, because we're very pressed for time. Did you want to take the question from Chris?
Yes.
Here?
Yes.
So please.
Yeah, thanks, Nick. And Chris, that's a great question, right? So I'm not sure others can see, but anyway, so this seems like it's a leveling up of the concept of object-oriented programming, with AI being able to manage the complexity of the object design and interactions within the broader context of a given solution. What's the advantage of using a system or doing this yourself via general purpose AI tools? A great question, right? I think I'm really glad you asked this. If you take a general purpose AI tool, what you really get is essentially, to put it crudely, what you can get out is code, which you would need to then build. You need to test it independently and then deploy it and get it validated and make sure that it complies, every auditability test passes, and so on. What Tapestry does is really not just generate code. In fact, it doesn't generate code at all. All the code that needs to be run is already pre-existing on that, which means that no new code is being created, which means compliance becomes a cakewalk. And it assembles together existing products, and you can actually run it right there within that. It's not a tool to generate a workflow which you take elsewhere and run. You can run it right within that, and not just run within it for testing. You can actually deploy on an identical higher scale system for production use from within Tapestry, which means that you build, test, and deploy all within the same platform. So it's very different from a general purpose AI tool. I hope that gives you a sense of what makes Tapestry different than a general purpose AI tool. And I'll be glad to take this more offline as well.
Perfect. Well, thanks very much for that, Arun. It's been a pleasure joining you today to talk about this topic. Hopefully it's been a useful one for everyone attending, and you've been as interested in this conversation as we have. The recording and slides will be available after the webinar, so please check those out, and those links we will share as well for some materials about some aspects of this. All that's left for me to say is thanks very much for joining us today. It's been a pleasure speaking to you, and have a great rest of your week.
Thanks, Nick. Thanks, everybody, for joining. Thank you.